Hey everybody, Michael Stead here, founder of the Abundance Society, where we teach you how to invest and grow your money the way the rich and the wealthy do so that you can create the financial freedom and prosperity that you deserve. And welcome to the video today called The Mutual Fund Fallacy, why mutual funds are the worst investments and why you should stay away from them, period. Now, before we get to the reasons why they are the worst investments, I wanted to start off today's video with a quick story which I call The Dilemma, because I think it's something you might be able to relate to in your own personal situation. So here it goes. You're newly graduated from college and begin making your way into the working world. Then you begin hearing all this complicated financial terminology and jargon which you know absolutely nothing about. You begin hearing words such as mutual funds, dollar cost averaging, compounding interest, RRSPs, TFSAs, 401ks, IRAs, so on and so forth, diversification, contribution matching, and needless to say, it's enough to make your head hurt. Not only that, but you begin making some decent income from your job and you begin to start accumulating some money. And you know that you should be doing something with it, but you don't know what you should be doing with it. Your friends and family seem just as confused as you are, and you aren't sure who to turn to in order to get the right advice and the right guidance. So you do what most people do in this situation, and they go down and talk to their local financial advisor. Now, when you sit down with this individual, he seems very intelligent, very well educated, and he begins saying things such as, we need to diversify your money. Don't put all your eggs in one basket. And he starts showing you these fancy pie charts and graphs that he put together, which shows you how well allocated you are in all these different investments if you were to pursue business with him. Not only that, but he shows you these charts where he shows you the benefits of investing over the long term and shows you how much your money would have grown over the past 30 or 40 years by simply just putting it in the market and just letting it ride, so to speak. Not only that, but you start to get very, very excited about your future. You start to see the benefits of money and investing and saving for the future. And you start to get excited because this individual you're speaking with sounds very smart and sophisticated, seems very friendly, and seems to have a genuine interest in wanting to help you. However, because you're unsure of what to ask, he doesn't discuss his compensation with you or how he benefits directly by working with you. All you know is that he is going to manage your money on your behalf so that in the future you can retire blissfully happy. Because you're comfortable with this individual and you're confident in their abilities, you start to ignore your financial situation because someone else is looking after that for you. So therefore, you begin to ignore the financial markets because you're just too busy to follow them, and quite frankly, they're just too hard to understand. You focus on what you do, and your advisor manages your money, and everything seems to be completely fine. Until one day we experience a financial meltdown. The stock market crashes, interest rates tick up violently, and your account starts to go down in value. You're unsure of what to do because you see the value of your account plummeting day by day, and when you contact your advisor, he consoles you and says, don't worry about it. Now is not the time to sell. We're in this for the long haul, remember? Remember the benefits of investing over the long term? Everything's going to go back to normal. Everything will be fine. And even though he says this, you're still worried, you're scared, and you're unsure of what to do because you don't understand what is happening and you don't know how to respond to it. Now, obviously, I shared this story just for illustration purposes, but it was my hope that you were able to relate to the story somehow with your own personal situation. And if this sounds like a similar experience that you had, and you're still unsure of what to do and what to make of this entire situation, here's where you need to have a massive paradigm shift and really look at this look at the financial industry through a whole different set of glasses, so to speak. And where I want to point your attention to first off is I want to show you something quite interesting. And as you can see here, I'm talking about the Forbes 400. And as you know, the Forbes 400 is the 400 wealthiest people in America. And in this magazine, it basically shows these individuals and shows how they accumulated their fortunes. Now that we know that, I want to show you something that's very telling and very interesting. So obviously I'm not going to go through the entire list because that would be a far longer video than you or I personally have time for, but I want to point out a few key people here. So as you can see here, the seventh wealthiest person on the planet is George Soros, and he has a net worth, they're estimating, around $22 billion, and he made his wealth through hedge funds. Now I know what you're thinking. Wait a second. I thought we were talking about mutual funds. Now you're talking about hedge funds. What's the difference? Well, a mutual fund and a hedge fund, they do have similarities and they also have some differences. The similarities that are important for our purposes is that both of these types of funds is where money is being managed on someone else's behalf. Okay? So now that you understand that we're going to talk about more about what that means in a moment. But this should be very, very telling for you and very, very important for our purposes here. So he's the seventh wealthiest person on the planet. Now the next person I want to point you to is an individual named John Paulson, who is the 17th wealthiest person on the planet, and Forbes is estimating his net worth is around $15.5 billion. And again, his wealth is made through hedge funds. Another individual, a little bit farther down the list, but same thing applies. His name is Charles Johnson. He's the 72nd wealthiest person, and he has a net worth of around $4.4 billion. And as you can see here, he made his wealth through financial services. And I wanted to just pull up his profile and just get a little bit more information on this individual. And as you can see in the bold red underline there, his firm has more than $10 billion in assets under management. And if you're unsure of what that means or the significance of that, we're going to talk about what that means here in a moment. But here's what you really need to understand about this entire situation, and here's the truth of the matter. The richest people in the world don't invest in mutual funds. They sell them to you. Oh. You see, guys, the wealthiest people in the world, they're not directly investing in these mutual funds. They're merely selling them to you, and they're benefiting on your behalf. And if you were to go through the entire Forbes 400 list, you wouldn't find one individual, not one, and I'll post the link below this video so you can check it out for yourself. There's not one individual on the list that has made their fortune by investing in mutual funds. And just to show you something kind of interesting, this is actually the Standard & Poor's 500, the S&P 500. It's basically just a collection of the 500 largest blue chip stocks. And over the last 10 years, this index fund has done around 46%. Now, if you invested 10 years ago, that means your account would be up 46%. Now, a lot of people think, that's pretty good. But here's the thing. If you average that out, that's only around 4.6% per year. And while your account may be up in nominal terms, the US dollar, has lost more than 30% of its value over the past decade. So while you may have made nominal gains and your account might be up, you haven't gained in purchasing power, which means that you have actually lost a substantial amount of money, even though you've invested over the long term like your advisor had advised you to do. Not only that, but this doesn't take into consideration, the taxes that you may have had to pay on that money, or the fees that have been extracted from your account by your advisor managing your money on your behalf. And what's really quite disturbing about this was that over the past 10 years, it's done around 46%. The S&P has. Over 80% of the mutual funds out there that are sold, they underperform this market benchmark. So in other words, even though that fund has returned around 4.6% per year, many of the fund, or over 80% of the funds out there today, they underperform this, which means they're losing even more money. And when you really begin to understand this information, you begin to realize that the real business that financial institutions are in is really only one of two things. Number one, It's asset accumulation. And if you're not sure what that means, it basically, their main job and objective and chief aim is to collect as much money as they possibly can so that they can extract fees and commissions from you. So, and then the second business is the marketing and selling of financial products. I mean, obviously they're a business and they're in it to make money. Now, just as an example, just to show you the significance behind this and what this really means for you, if a mutual fund has $1 billion under management and they charge a 2% MER on that fund, and if you're not sure what MER means, it's an acronym which stands for Management Expense Ratio. So, if they're collecting 2% on $1 billion, think about this for a moment, guys, 2% on $1 billion. Well, that means that the fund managers are collecting more than $20 million per year, regardless of how the market performs. So even though you may have lost money one year, and if it was another event such as 2008 where you may have lost 30 to 40%, the fund managers are still collecting that fee no matter what happens in the market. So just think about that for one moment. Think about what that really means. And here's some questions for you to consider. How much are you really paying in management fees? And these questions are directed if you're still invested in mutual funds right now. I want you to reflect upon and what this really means. So question number one, how much are you really paying in management fees? Do you know the actual number? What is the management expense ratio that you are paying? Do you know what this number is? What is the load, aka the commission, that you are paying to the advisor? Do you know what that number is? Do you know what the administrative costs are that you are paying to this fund? Do you know what that is? Not only that, but do you even know what the names of the funds that you are invested in are called right now? And if so, do you know what companies are invested in the funds? Do you know what the company's track records are, who their management teams are, and what their competitive advantages is in the marketplace? And the last question, and this is probably the most telling, has your advisor ever given you a hard time because you told him or her that you wanted to sell or withdraw funds from their firm? Now, if you have, and based on what you just learned, this isn't too hard to understand why they may have done that. Because obviously, their main aim is to get as many assets under management as possible. And when you withdraw money from their account, their fees that they're able to extract goes down. So by having you invested over the long term, that way they're able to make as much fees and commissions off you as possible. Now, I know this was a little bit longer video than I normally do, but to thank you, I have a free gift for you. If you like this video and you want to learn more about how money and the financial system works, I have created a 90-minute free webinar presentation which you can attend for free. And you're going to learn things on this presentation such as what the real cause of the financial crisis has been and how it has been quietly lurking over the past 100 years. You're going to learn, should the U.S. tax the rich or cut spending in order to balance the budget? Or does it even really matter at this point in time? You're going to learn, is your retirement account and job safe from the coming economic collapse? And mark my words, it is fastly approaching our way. You're going to learn, is the U.S. the next Zimbabwe? And if you're not sure what that reference means, we're going to cover that on the presentation. We're going to do a case study, which I'm going to show you how you could have taken a one-time investment of $10,000 and literally transformed it into more than $100 million. And I'm not kidding when I say that. This is a very, very powerful concept. I'm going to show you, and lastly, I'm going to show you how to position your assets correctly to be on the winning side of the wealth transfer, the way the rich and the wealthy are preparing right now so that you can do the same yourself. So if you want to get access to this free webinar presentation, all you have to do is click the button below this presentation. Just click the link below this video to get instant access right now. So once again, thank you so much for watching this video. As I mentioned, my name is Michael Stead. I'm the founder of the Abundance Society. If you like this video, just click on the link below to get access to the webinar. Questions, comments, let me know. Leave them in the box below. Let me know what you thought. And if you like this video, make sure you subscribe to this channel because we're going to do our very best to create even more videos like this to educate the public on exactly how the financial industry works and how you can take control of your financial future. So with that being said, thank you so much. Again, if you want to get access to the webinar, just click on the link below and we'll see you on the other side. Take care and have a great day.